If you had to invest $50,000 today in only 10 stocks and leave them untouched for 25 years, which companies would be at the top of your list? I mean, obviously you want the best growth, but the companies need to have long-term appeal. And if you pick wrong, well,
nothing for you.
Now, this happened to be a challenge that someone had posed to me, and I realized that it isn't very realistic, but that's not the point. The point is, if you had to pick the best options with what you know today for the long term, what would they be? Not only am I going to break down my list in this video, but I'm also going to share what a couple of other YouTubers like Eli from Dividendology and also Joseph Hogue would have on their lists. And I have to say that I am a bit of a risk taker, so I can assure you my list is not just the top 10 S&P 500 stocks. But of course, with these comparisons, you're going to get a great baseline to start with. And of course, you can look at my list, their lists, and then of course you can let us know in the comments what you would have done differently. We'll go ahead and we're going to build out that forever list in this video today. And here's a quick overview or brief of what the businesses need to be, with durable advantages that won't decline over time, with balance sheets that are stout enough to ride out the market downturns and recessions, and cash flows that compound like clockwork for the next 2.5 decades. Now, why is it so important to hand select only the best of the best? Well, since 1926, of the 26,000 US stocks, only about 1,000, or about 4%, of US stocks created all of the market's net wealth. That means that the remaining 25,000 stocks were barely treading water and really barely meeting inflation. So if you miss that top sliver of 4%, then your portfolio is going to suck. But hey, that's why ETFs are so good, but that's for a different discussion. So in the next few minutes, I'm going to reveal the 10 names that I would personally trust with my own $50,000 for the long haul. There's no trading, there's no tinkering, and once again, this is not financial advice. It's just me providing a little bit of a blueprint that what I would be willing to give to my own children. So go ahead, grab your coffee, settle in, and let's start with that number 10 stock of Microsoft, whose 10-year annualized return is 28.7%, and that definitely dwarfs the S&P 500's 11% compounding every year. And that's thanks to its pivot from Windows going over to cloud-based, and also their AI investments under their current leadership. And of course, there's Azure's growth, which has been north of 20% annually, and a $13 billion OpenAI partnership that put it at the center of next-gen AI services. So, with net cash of around $80 billion and a 12% revenue plowed into R&D, it maintains a fortress balance sheet and a durable moat across enterprise software, gaming, and productivity. Plus, they have operating margins which are north of 40% and a 20-year CAGR of 14%. That all proves that it has compounding power. Next, analysts expect free cash flow to double over the next decade as Copilot and Teams AI really drive more adoption. Now, even if AI hype cools, the recurring Office 365 and Windows cash flows offer super strong downside protection. So for my money, for a 25-year hold, Microsoft's scale, their recurring revenues, and their tech stack moat make it a bedrock holding, where analysts see them with over 18% growth for the next 12 months. My next pick is Google, where their search ads engine still grows mid-teens annually, generating $198 billion in revenue, and Q1 2025 revenue hit $90.2 billion. That's up 12% year over year. And then there's Google Cloud, which is running 25 to 30% growth as enterprises are really embedding into their AI-driven analytics. Not to mention, they also have a massive $75 billion data center capex and a sprawling ad tech ecosystem really keep it neck and neck with AWS and Azure. On top of all that, their free cash flow margins are north of 20%, which funds both their buybacks and their moonshot bets like Waymo. And in my opinion, Google's Waymo doesn't get nearly as much credit as they truly deserve. I mean, honestly, they have been running automated taxi services for way longer than Tesla, but we just don't really hear about it. Moving along, over 20 years, Google delivered a 16.6% annual return, which is 1.5 times the S&P 500. And here's the thing. With Gemini-powered search, YouTube monetization tailwinds, and a solid cloud momentum, 12 to 15% annualized returns look totally normal for their future run rate. Granted, regulatory risk looms over their heads, but with $95 billion in reserves, I honestly feel that any fines or breakups really could be absorbed easily. Analysts give Google just over 10% upside for the next 12 months. And here's the thing. With Microsoft and Alphabet, neither of them really have much of an impact from tariffs. The majority of their businesses have some insulation against the tariffs, except for where they may be using their money in capital expenditures, like for new data centers, offices, or any infrastructure. Okay, I have a question for you. Are you anything like me where you have several 100,000 points on your credit cards, but the requirements to use these points make them nearly impossible to use? Plus, the points seem to keep depreciating over time. Instead, what if those points were invested into an asset with solid potential growth? That's where today's sponsor, Gemini, can help all of us out with the Bitcoin credit card, which rewards every single purchase with an investment into Bitcoin or any other offered 50 cryptos of your choice, all with no annual fee, and you can feel free to check out the description to learn more details. And because the Gemini credit card is also a MasterCard Elite, so you happen to know that you can use it anywhere that MasterCard is accepted, and it comes with benefits from that Elite status. So when you happen to go out and buy lunch, gas, or even your weekly groceries, you're going to be getting a percentage back that is invested into Bitcoin or, like I said, up to 50 other cryptos straight from your account. Those of you that get my newsletter, you already know that I invest roughly 5% into Bitcoin or other crypto as an alternative asset. And this credit card is the perfect way to create that type of investment from simply using your credit card. Bitcoin rewards earned and held for 1 year on Gemini credit card have appreciated 176% on average. You're investing as you spend. It's truly a no-brainer. And as an added incentive, if you sign up for the card at gemini.com/Brian and get $200 in Bitcoin when you spend $3,000 in the first 90 days. Next, we'll move on to my ex-employer of Amazon, where AWS, which is 60% of Amazon's operating income, had grown 17% in Q1 of 2025 to $29.3 billion, and it remains the global leader. And then their retail portion of the business continues to have high single-digit growth via their same-day delivery, their private label, and also their warehouse automation. And Amazon's $100 million AI investment in Bedrock and Agent Core, it targets the blooming agentic AI market, potentially creating billions in revenue. On top of all that, their free cash flow has averaged greater than $20 billion annually, funding their CapEx and their buybacks. Now, if you take a step back and you exclude COVID, Amazon has returned 25% annually over the past decade, and that really underscores its power to compound over time. AWS's enterprise moat and their retail momentum in emerging markets really gives it a long runway, and I see them with 10 to 12% annual returns under conservative multiples. And Amazon will clearly have a lot of impact from the tariffs, but they're one of the few retailers that won't lose too much momentum in the sales because, well, they happen to be one of the lower priced leaders. Analysts are giving Amazon a little bit more love than most companies with over 18% upside. And moving on to an obvious favorite, which happens to be nvidia, whose revenue leapt from $5 billion in 2016 up to $60 billion in 2024. That happens to be the fastest scale up in corporate history. And no surprise, it's driven by AI training workloads and data center GPUs. In fact, its data center segment grew 427% in Q1 of 2025, with roughly a 90% market share in data center GPUs. They also have partnerships with Mercedes and Toyota in autonomous vehicles and robotics, which expands its total addressable market. And their gross margins are all above 70%, which is mind-blowing. And of course, they have that free cash flow yields to truly finance that relentless R&D. Now, if you're to run some backtesting, it shows that 79% annualized returns over the last decade, with the AI hardware market projecting 27% CAGR up to 2030. So NVIDIA is uniquely capturing the bulk of the AI spend worldwide. Analysts only give NVIDIA nearly a 2% upside for the next 12 months, but seeing as how they've continuously been wrong over the past 2 years, I'm really not going to worry too much about the forecast. Next is Visa, who process 233 billion transactions a year, and their global digital payments are growing at 21% annually, and they're set to quadruple by 2030. And I was shocked to learn that their operating margins are greater than 60%, which makes them a very high-quality financial business. And over the past 10 years, Visa delivered a 16% annual return, and that's really powered by their network effects and their near-zero credit risk. They're also also reinvesting into real-time payments and also into the buy now, pay later, which is unlocking completely new high-margin streams. They happen to have a fortress balance sheet, and 16 years of dividend hikes give them both growth and inflation protection. Analysts give Visa a healthy 18% upside for the next 12 months. Now for my complete surprise addition, which is Mercado Libre, which is Latin America's dominant e-commerce and fintech ecosystem. They're often dubbed the region's Amazon, with a digital payment arm akin to PayPal. The company enjoys strong tailwinds as Latin American consumers come online and shift from cash to digital commerce, where e-commerce penetration is still only in the mid-teens and cash transactions have been falling, where users indicated a 79% drop in cash usage. Mercado Libre has a long track record of high growth, compounding revenue at 43% annually from 2021 to 2024, where they happened to reach $20.8 billion just last year, and is scaling profitably, where 2024 saw a 38% revenue growth with GAAP earnings surging 90%. Without a doubt, they have a very competitive moat, and it's a powerful network effect because it has an end-to-end ecosystem. So there's more buyers and sellers, which happen to attract each other, and it's reinforced by the company's own logistical network and, of course, their payment system that is unique to them. So let's double click on that for a second. That fintech segment, which is their payment area, kind of like PayPal, well, it has jumped 72% recently, with about 64 million active users that are now just using the digital wallets. And these are services well above their core business of shopping. With some high-level stats, they have over 100 million active buyers, and that's just a slice of their 450 million adults in that area. To boil it down, Mercado Libre has immense room to expand because, well, it's underpenetrated and they have a big moat for what they do in their area. In fact, analysts give Mercado Libre a forecast of over 22% upside for the next 12 months. Now I'm going to spice it up with me throwing in my future tech pick with IonQ, which is one of my favorite pure play quantum computing stocks. IonQ recently reported their Q1 2025 revenue of $7.6 million, and they reaffirmed a full year 2025 revenue guidance of $75 to $95 million. Its trapped ion architecture is intended to deliver 99.9% 2-qubit gate fidelity and all-to-all connectivity, far outperforming superconducting peers on error correction overhead. Strategic partnerships and acquisitions of ID Quantique and LightSync bolster its IP portfolio, which now happens to have over 950 patents. And the global quantum computing market, valued at $1.8 billion in 2025, is projected to grow at a 32.7% CAGR to $5.3 billion by 2029. With AQ64 commercialization and hybrid cloud integration and an early lead in quantum networking, IonQ sits on a multi-decade growth runway. In fact, they're targeting a break-even point by 2030, and they happen to offer asymmetric upside if their trapped ion technology scales and unlocks widespread commercial use before the others. Analysts give IonQ just over 20% goodness in their next 12-month forecast. Now, before moving on, I do want to remind you that I'm going to provide the top 10 list also from Eli from his channel Dividendology, and also Joseph Hogue's list, which we can see all the comparisons all at once. Next, I'm throwing in my perfect option to weather the economy's ups and the downs, which happens to be Costco, whose membership model has fueled a 4.6% EBITDA margin and a 4.8% operating cash flow margin. In fact, over the past 20 years, Costco has had a compounding annual return of 16%, which beats all of their retail peers. And when you look at what they're known for, their Kirkland signature private label brand, that happened to grow from $3 billion in 2002 up to $86 billion now in 2024, boosting their margins and their loyalty. But a big opportunity exists in their e-commerce, which is only 3% of their sales. So if they were to focus more on their online grocery and their same-day delivery, they offer a lot of upside. In addition, they're also focusing on international expansion, where they happen to have 24 new stores opening just in 2025. And there's no surprise that they have a pristine balance sheet, and their self-funded growth really keeps dilution at bay. And Costco happens to be sitting with over 12% upside with analyst expectations. Now for a another pure play stock that will have lasting power, and that's CrowdStrike, whose Q1 fiscal 26 revenue came in at $1.1 billion, which is up 20% year over year, which is driven by strong demand for its cloud-native Falcon security platform. And its annual recurring revenue hit $4.4 billion, or a 22% jump. And their subscription gross margins reached a record 80%, underscoring really both their revenue visibility and their high profitability. The global cybersecurity market is forecasted to exceed $500 billion by 2032, growing at a 12% CAGR. And I think that's conservative, seeing how these threats are just growing and growing each and every day. Now that these bad actors can use AI, it's getting out of control, and we need more resources and companies like this to keep them at bay. And like many of these other companies, they have a deep moat based on their deep integrations with major cloud platforms like AWS, Azure, and Google Cloud. And they also have strategic AI partnerships with companies like nvidia. All of these layers really entrench their Falcon system as a mission-critical defense layer for enterprises and governments everywhere. In fact, its net dollar retention is north of 120%, meaning that their existing customers are expanding their use and consumption. Like I said, these threats are growing and growing, and as cyber defense becomes non-discretionary, CrowdStrike really stands to compound strongly over the next 25 years. And currently, analysts are giving CrowdStrike a 14% upside over the next 12 months. Now on to one of my favorites of Palantir, whose Q2 revenue rose 48% year over year to over $1 billion, with US revenue growing at 68% year over year, and their US commercial growing at 93% year over year to over $306 million. And it's just wild that this is their first $1 billion quarter. And their profitability scaled hard. Their adjusted operating income at $464 million and $6 billion in cash with absolutely no debt. And already the management has raised their fiscal 25 guidance to a revenue between $4.14 and $4.15 billion. And management has already raised their fiscal 25 guidance for their revenue, their adjusted free cash flow, and also the adjusted operating income. And they're also expecting their US commercial revenue to end at over 85% growth for the year. And without a doubt, their operating quality remains elite. Their net dollar retention is over 128%, meaning that the customers are very sticky and they're happy to stay with them and they're buying additional services. And their adjusted gross margins are at 82%, which is also a very sticky signal. And that happens to be a very high margin software economics. On top of all of that, their deal momentum is accelerating with record total contract value of over $2.3 billion. And of course, we all hear about the defense tailwinds, which has deepened via their new 10-year US Army enterprise agreement that's valued over $10 billion. And I am so excited to say that their Q3 revenue guidance has increased to well over $1 billion. And they happen to have a Rule of 40 score of 94. All of this points to continued scale with very fine detail and discipline. Analysts happen to give Palantir a negative 16% downside. And as you know, analysts have consistently been wrong about Palantir. So this is one that I keep dollar cost averaging, and I'm going to ride it out for the next several decades, no problem. Now let's take a quick moment and listen to what Eli from Dividendology happened to list for his top 10 forever stocks, and then we're going to marry up with mine and then also Joseph Hogue's.
What are 10 companies that you can buy and hold forever? This is a great question, and it reminds me of the old Warren Buffett quote, "Our favorite holding period is forever." The difficulty in that is figuring out which companies have the ability to withstand the test of time. If we look at the largest US companies by market cap over the decades, you can see it fluctuates quite a bit. Mediocre companies come and go, but the greatest companies all have one thing in common. They have what Warren Buffett refers to as a moat. A good business is like a strong castle with a deep moat around it. I want sharks in the moat. I want it untouchable. What does this mean? Well, a moat is a company's sustainable competitive advantage that protects it from competitors and helps it maintain long-term profitability. And those competitive advantages typically get placed into 6 categories: brand power, network effects, switching cost, cost advantages, intangible assets, and efficient scale. Now, if you went to business school, you're probably familiar with these terms, but I'm gonna let you in on a little secret. There's typically 2 places in a company's fundamentals where you can see whether or not they have any of these competitive advantages. Let's look at an example. To start, let's take a closer look at Microsoft. And obviously, there's a lot to like about Microsoft. In fact, Microsoft is actually one of the largest individual holdings in my personal portfolio. The company's growing revenue, they're growing earnings, free cash flow, they're buying back shares, and their debt to assets ratio is getting healthier every single year. But there's one key metric most investors gloss over that really reveals whether or not a company has a sustainable competitive advantage, and that is return on invested capital. What is ROIC? Well, to put it simply, it tells us how profitable are the projects the company is investing their capital into. Warren Buffett's business partner, Charlie Munger, once stated that over the long term, it's hard for a stock to earn a much better return than the business which underlies it. What he's really saying is if a company has a high level of return on invested capital over the long term, you should do quite well. If it's the opposite, then you'll probably do poorly. So what is a good return on invested capital? Well, typically as a baseline, we want to see at least 10%, but high quality companies can achieve 20%. And if we look at Microsoft over the last 4 years, they've been well above 20%. Quite impressive, a sign of a competitive advantage. But along with this, I want to point out something else. Let's take a look at Microsoft on the profitability sheet. The other sign of a clear competitive advantage is a stable or even growing gross profit ratio. For example, look at Microsoft's gross profitability over the last decade. Their 10-year average gross profit ratio is 67%. But last year, it came in at 69.76%. This is a sign of a wide moat. It's a sign of a competitive advantage. So when we think about stocks with competitive advantages that we want to hold forever, yes, these are all things to look for, but at the end of the day, they're going to have higher levels of return on invested capital and a sustainable gross profit ratio. So what are those 10 stocks? Well, we can see we have Microsoft, Visa, MasterCard, ASML, Broadcom, Costco, Canadian National Railway, Waste Management, MPLX, and JP Morgan Chase. And like I mentioned, what do you notice about these companies? In 2024, for the most part, they all had relatively high returns on invested capital, with the exception of JP Morgan, which for a bank stock, it's actually not that important of a metric. Along with this, they have phenomenal gross profit ratios. They're staying stable or even improving. And because these 10 stocks have phenomenal metrics here, they're able to grow free cash flow at a high rate, meaning over the long term, they can reward shareholders with a rapidly growing dividend. The vast majority of the stocks on this list are growing their dividend payments at a high rate. So let's briefly touch on just a few of these holdings and why you can buy and hold them forever. We'll go through these rapid fire. To start, Microsoft. If you look at page 19 of Microsoft's investor presentation, we'll see their selected product and service information. Microsoft has 20 different products. It's basically a tech ETF at this point, and the vast majority of their products are all growing at high double-digit rates. Let's talk about ASML. ASML has a monopoly when it comes to EUV lithography machines. Without ASML, there's no Taiwan Semiconductor or Intel, and without those things, there's no Apple or Qualcomm chips, no NVIDIA GPUs. Without ASML, the entire way we live our lives on a day-to-day basis changes. Canadian National Railway. Probably not a company a lot of people would expect to be on this list, but Canadian National Railway has irreplaceable infrastructure and their industry has massive barriers to entry. It's very capital intensive, and it would take decades to replicate what they've built. Because of this, they're going to be around for a very long time. And then we have Waste Management. Waste Management highlights in their investors presentation that 75% of their revenue has annuity-like characteristics. It's essentially recurring revenue. These are the types of things we want to look for when picking stocks that we can buy and hold forever.
I absolutely love how Eli breaks down the data, and he makes it so easy to understand really what he's thinking and why it's so valuable. Now we're going to shift over to Joseph Hogue's portion. And I have to admit, he was a late addition to the video, so he asked me to reference this video right over here, which he had done earlier in the year. And you'll notice his list is very AI focused, and it leans in heavily into growth. And there is nothing wrong with that at all. And I'll be honest, I considered several of these for my own, and they're all fantastic, where we didn't have any overlaps between our two lists. And I'm going to highlight the fact that I love Dell, Marvell, Supermicro, and Symbotic the most from his list. As a quick summary, Eli from Dividendology and I only had 3 companies that overlapped. And I think that we did approach this very similarly, where Eli had a laser focus on the analytics. And of course, I took a few extra risks based on future technology. And when it comes to Joseph Hogue, neither myself or Eli had any overlaps with his list. It's just an indication that, hey, we have a lot of great companies to choose from, so long as they're that top 4%. I would absolutely love it if you would take a moment and let us know in the comments what you think of the lists and what you would have done differently. Also, please let us know in the comments if you like this type of collaboration. Now, I do have to give a big thanks that goes out to Eli and Joseph for being willing to even collaborate with me on this. As always, thanks so much for watching.